Hi guys, welcome back to my channel. If you guys are new here, my name is Mel, and please go ahead, hit the like button, subscribe before you even get into it, because I promise you I'm going to add some value to you and your trades. This is going to be a super quick video. If you watched my intro to options video, and if you didn't, this is the video. I will put it down in the description box below. But after I put that video out, a lot of people ask, can you place a stop with options, or is there a way to kind of balance or mitigate your risk in options? And there is. So stay tuned. I'm going to show you how. Okay, so first things first, I need to answer this question because this was asked. Do I risk my entire option contract? Is that considered my 1 to 2% risk? And if you don't want to know what I'm talking about, I talked about risk management. I will also link that video below. But no, I do not risk the entire contract most of the time. And the reason why I say most of the time is because of this. So there's two scenarios. So if I buy a leap, which a leap is a long-term option. Usually your expiration is a year or longer. I'm looking at that as a more of like a buy and hold strategy. So if I pay $1,000 for that and I'm looking to hold it to next year, yes, because I'm looking to hold it with the hopes that it's going to move in my favor for over an extended period of time. So I'm looking at that more like a kind of a long-term hold versus now if I am buying an option with an expiration of 2 to 3 months, I use the 1 to 2% rule. Okay, so this is the 1 to 2% rule. If you missed the risk management video, the rule says that however much my total account value is, I'm only risking 1 to 2% of that total amount. Okay, so if I have a $10,000 account, I'm only risking $100 to $200. Okay, and so yeah, you can do that with equities or stocks or whatever you're trading, but you can also do it with options. And it's going to be a little bit different because when you buy options, if the contract costs you $1,000, it's not going to read like that. It's going to read 10.00 because remember, when you're trading options, you do have to multiply by 100. Okay, so let's get into the ways that you can and set a loss in options, or you can go another route to at least be on top of it to get out of the trade if you notice that it is starting to go against you. All right, guys, so I'm going to try to make this super quick. So there's two things that you can essentially do. Okay, so let's go back to the $10,000 account. So let's just say you have a $10,000 account, and this is the strategy that I've been using. But if you have a $10,000 account, and let's just say you want to buy an option on ABC Company. If you buy a call option that's cost you, it's gonna read $10, so to say 10.00, but remember, you're controlling 100 shares when you buy one contract, so you have to multiply this by 100. Okay, so this option contract will cost you $1,000, so you have a $1,000 call option that you're controlling. But let's just say you only want to risk your 2% max, which in this case, because you have a $10,000 account, would be $200. So you can do two things. You can either set you an alert, which I'll show you how to do it. So you can set an alert literally at 8 points, you do it a little bit up higher than when you get to 8, because you want to give yourself a little wiggle room to at least, make it to your computer or your phone to actually exit the position. So you can set an alert. So let's just say if you want to get out at 8.00, because that would be $200 because you bought in at 10, and remember, we're controlling 100 shares. So I would put an alert maybe at like 8.5. So when you got to like 8.5, your phone would alert you. The alert would come from your trading app that your price is below 8.5. So at this point, you could go on your computer, or you can get on your phone, and you could be looking to possibly get out because the trade is maybe going against you. Or the second thing you could do, which is what I typically do, and this is ideal for the person that maybe you work a job, maybe you open an option contract right before you walked into work, but you can't watch your screen all day because you're busy, because you're working. So what you could do is you could go ahead and you could set a stop market order. Okay, and notice I put emphasis on stop market order. So let me tell you why. So there's two type of stop orders. So you could do a stop limit order, or you can do a stop market order. Okay, so the difference is The stop limit order, it combines a stop order with a limit order, but you run the risk of your order not being filled. And let me explain it to you. So for example, just say if you put in a stop and you put in a stop limit order, and the market is, very volatile when the market first opens, the order has to hit your price, the exact price that you want to be taken out of the trade. It has to hit it and it has to be filled. So you run the risk of it not being filled, because if you have multiple people and multiple orders trying to get filled at the same time, it may not pick your order up. And so you may have a severe loss. So instead of you wanting to risk $200, by the time you look at your phone, you could be down to $400 or $500. Okay. So this is why I do not really care for stop limit orders. What I do prefer is a stop market order. So a stop market order is an order to buy or sell at the market price once your price hits. Your stop price hits. So in that same example with the stop limit order, if you put in 8.5, but the market is super volatile and it could just really blow right past your 8.5. But if you put in a stop market order at 8.5, you may miss it just a little bit. So if the market is really volatile, it might shoot past 8.5, but it is going to get you really, really close to the next best order that they can fill it at. So instead of 8.5, you might be filled at, 8.45 or 8.46 or something like that. You're going to be really, really close to where your stop price was. So this is why I prefer to use a stop market order. All right, guys, so I am in my sim account now. So I have the NVIDIA option chain pulled up, of course, because we love NVIDIA. I am on let's pick an expiration of November 15th. So on the November 15th expiration, I want to do it at the money option contract. So let's do 120, and we're going to do a call option. So we're going to do an 11:15 call. Okay. So I'm going to pretend like we bought this contract and we paid the $1,100 for it, which you can see it's at 11.00. And remember, we got to multiply by 100. So I'm going to pretend like we bought this because the market is closed. So I can't show you this live. And once again, it's in the sim account, and you can see up here at the top as well. It's telling you that your max loss is at 1,100, but we're not going to risk that in this situation. So this is what I'm doing. So what we're going to do is I'm going to hit, I'm going to pretend like I'm trying to place a stop market order. Okay. And so the thing with options, a lot of times with equities, you can set this order before you even initiate the trade. If you or somebody's watching this and you know how to do this before even initiating the trade, or when you initiate the trade, please comment down below and let me know, because I haven't figured that out yet. I know I can do this though once the trade is initiated. But back to the trade. So let's just say we're open and we're losing. So we can put in a stop market, and so you see down here it says order type. Okay. So you got a stop limit and you have your stop market order. This is why I do the stop market order. Okay, so I'm going to change this to stop market. And if I only want to risk $200 in this scenario, since I paid $1,100 for, I want to make sure that it's going to take me out at 200. So 11 minus 2, of course, is 9. So I'm going to put this at 9.00. I leave this the same, and I change it to good to close or good to canceled. And that's what the GTC means. Or you can put a day, but just know that if you do a day order, if the market closes and your position isn't closed out, you're going to have to go back in the next day and do this all over again. So I always just put good to close. So yeah, and so it's showing right here natural mid and far because the market is not open, but I'm going to leave it like this. So I'm going to leave 9, and then I will hit send order, and then your confirmation order will pop up. And you're just making sure that you have a stop market order. And then if I try to hit send because the market is closed, of course I'm going to get this error message. So that's how you could do that. Another thing you can do, and this trade is not open, but what you can do is you can go in and you can set an alert on this trade. And since I paid $1,100 for it, I would set an alert at maybe around like 9.5 or 6. That way, you know, if I'm at home and I don't necessarily want to place a stock market, I maybe kind of want to watch it a little bit more, I can set an alert, and that way I can go in and I can be mindful of what's going on. That way I can just kind of take myself out of the trade and just put that stop in later. So yeah, that's the two ways you can do it. You can do a alert, or you could do a stop market order. You could do a stop limit order, but just know that you may or may not get out of that trade. All right, so we're almost done, but I do want to tell you of some things to take into consideration when using stock markets with options. If you probably heard, if you trade, you know, but if you don't trade, a lot of times I've said to people, I feel like I can control stocks better than I can control options. And this is why. So if you trade options and you put in a stock market to take you out, it could be possible, depending on what option contract you bought, that you could be taken out of an option trade prematurely. And by that, I mean, let's just say you have a zone. So I trade off of buyers and sellers zones. So let's just say you have a $10 zone, right? If you buy an option contract that's at the money, and you want to get out only, you know, risking $200, it's possible that you could be taken out of a trade while you're still in that zone, as far as what the stock is concerned. Now we're talking about options, but you are getting into the option contract based off how the stock is moving. So just keep that in mind. And that's why sometimes I always say I prefer trading stocks over options because of that reason. But I may have kind of cracked the code. I have been doing something lately that has helped a lot on that. And it involves buying out of the money options sometimes in certain situations, which I won't dive deep into it in this video. But if you're interested in seeing how I use that strategy, comment strategy down below, and we can do it another day. Okay, we can come back and we can do it all over again. And also join the Discord. I will also link that in the description box below, because you can ask some questions. I can kind of give you some insight onto, you know, how I do that, or just any other, you know, general question that you may have about stocks or options. Okay. But yeah, that's it. That's the video. I appreciate you guys once again for coming in, watching this video. Thank you for your time. I always say time is so precious. So thank you for your time. Be on the lookout for another video coming up soon. And yeah, once again, like, subscribe, share this video with family, friends, brothers, sisters, neighbors, friends, whoever you can think of. And yeah, see you guys next time.